Hi everyone, and welcome to this explainer video for the interest rate converter. So if you have a look at the interest rate converter file over here, what you can see is that there are four different potential inputs. So we can either input the rate that is nominal annual compounded monthly, nominal annual compounded quarterly, nominal annual compounded semi-annually, or nominal annual compounded annually. And we're going to see how an annual interest rate is actually quite different to a quarterly compounding interest rate. So let's say we have an interest rate of 10%. So if we go and put in 10% on the file over here, we can see that it equates to a 10% annual rate. So 10% equals 10%, that makes sense. However, you can see that the monthly rate is actually slightly lower at 9.57%. Why is that? Well, the annual rate assumes that your interest is compounded annually. In other words, you calculate the interest on your debt balance once a year, and then that is added to the debt balance. A monthly rate assumes that the interest is calculated monthly and added to the debt balance each month. So in month 1, we calculate the interest of the debt balance multiplied by the interest rate that gets added to the balance, and in month 2 we calculate the interest as the interest rate multiplied by the debt balance, which now includes the interest that was calculated in month 1. We can see how this compounding effect would actually go on over the year, and if you apply the exact same interest rate at 10% each month, your total amount of interest will actually be higher. That is why 10% as an annual rate is actually equivalent to 9.57% if you compound monthly. Let's take a look how that works in the example. So this is a short example that I just put together to show the difference between compounding interest rates. So as you can see over here, we assume a 10% interest rate, but actually this is being compounded quarterly. So we can see we've got the 4 quarters of the year over here. We've got the start date and the end date. And we've got 1,000 as the loan value is the start of the quarter. So the balance of the loan is 1,000. So the interest accrued in this quarter is 10% applied for the quarter. So we're just multiplying over here 10% multiplied by the number of days between those two dates, and then dividing it by the total number of days in the year. And we can see there that that equates to an interest of 24.86. So we add that to the loan value at the end of that quarter. Now, in the next quarter, we can see that the interest is slightly higher, and the reason for that is because we are actually applying the interest to a loan balance of 102.486, which is the initial 1,000 plus the interest that was calculated and compounded in the previous quarter. So we can see that the interest rate grows slightly over time, and in fact, if we had to graph that, we could see how it's growing. So if we do a simple annual calculation of 10%, the interest is simply 100 if we take the amount at the start of the year of 1,000, and the amount at the end of the year is 1,100. We can see when we compound quarterly using the same interest rate of 10%, our ending value is actually slightly higher than 1,100. It's 1,103. So we can see that there's a slight differential there. And obviously when we're talking about loans of very big values, this compounding does start to take an effect whether you compound quarterly or annually. So if we go back to the interest rate converter, what we said is that if we're actually applying 10% quarterly, so let's do that, then it's actually equivalent to 10.38% if we just compound annually, in other words, apply it once off. 10% over there is actually equal to 10.38% applied once off, and we can see there now the compounding quarterly and annually we get to very similar figures, just off by 1 cent. So you can see that there are probably a couple of additional numbers after the 0.38 over there that I didn't include, but we roughly get to the same answer. So quite interesting to note that 10% if we compound quarterly as an interest rate is actually equivalent to an annual interest rate of 10.38%. This is what the interest rate converter does. It allows us to convert between annual, semi-annual, quarterly or monthly interest rates to the other type of interest rate, so we can see an effect. So if somebody quotes you a 10% interest rate compounding quarterly, that is actually a 10.38% effective annual interest rate.